Hi, we're discussing financial capital in communities, and we'll begin by just thinking about a few issues that affect financial capital availability for local communities. And the big question, I think, do consumers and firms have an adequate supply of credit? And credit is important because it allows people to make investments. Uh, for many people, of course, the only way they acquire any kind of wealth is to own a home. So mortgage lending is central to that. And also, people who are entrepreneurial and wish to start businesses often need small business loans. And ultimately, at the community level, having the availability of capital ensures that there will be investment in the local community. So, some other questions that are relevant. What types of credit are being demanded? Well, some of that's going to be different from what's available, obviously. What is the structure of credit institutions in the community? So, what choices do people have? How well are local credit institutions meeting the needs of local residents? Are people getting the credit they need and deserve? And what options do people have if conventional lenders are not available? How well do credit institutions that serve a community market their services and products? So, even if there are local players, sometimes the information doesn't get out there. And I think another important sociological question, are minorities, women, and small businesses discriminated against in local credit markets? And sometimes we have evidence of this happening. So this is an important issue. So as we're thinking about available credit options for local residents, we should begin by noting some of the challenges that currently exist, as many low-income communities are targeted by predatory lending institutions, and that's because they know that their potential clients will be desperate to receive loans and are willing to pay high interest rates, like payday lenders who may charge as much as 40% interest so that people can have money when they need it. And when they get their paycheck, they're expected to return the money plus interest. So, high interest rates, abusive conditions on borrowing, fraudulent behavior, loans targeted at homeowners on the basis of specific characteristics. So, discrimination also happens here. But a lot of times, if these are the only options people have for credit, they can go deep into debt, which can ruin their credit score. And that, of course, can lead to more difficulty finding credit down the road from more legitimate lenders. One of the positive developments in the field of community development has been the creation of community development loan funds, which are privately owned, but they're nonprofit organizations that offer loans, usually in small amounts, but to enable low and moderate income people to obtain housing or jobs. Uh, and often these are made to businesses to create employment opportunities in local communities. And the banking institution has undergone a great deal of deregulation in the last couple of decades, ultimately leading to a financial crisis in 2007. But some of the regulations that were effective in the past were limits on interest charges, uh, instituting geographic restrictions in terms of where banks could offer loans, which would ensure reinvestment in particular regions, and investment options. So, one of the current debates is whether or not banking deregulation has achieved what the proponents were hoping, which is a more adaptive and responsive banking institution, or has the loss of some of these regulations led to further problems of discrimination and disinvestment in local communities? In the area of home mortgage lending, there's a federal mandate now for metropolitan statistical areas. Uh, Federally regulated depository institutions in them are required to report the number and amount of loans that they're giving out, and as well the race, gender, and credit scores and incomes of the loan recipients. So if there is any discrimination going on in terms of mortgage lending, it should be caught by uh, this federal regulation. One of the limitations, however, is that many rural areas exist outside of metropolitan statistical areas, and they have no such protections. So it's not a uniform solution. And so, because the current banking context in terms of conventional lenders is so problematic, many local communities have turned to community development based credit institutions. And this encompasses a range of options in terms of community development credit unions, which differ from conventional credit unions, who often grow larger than their original mission, which may have at one point been to serve a local area, but maybe that area is now underserved. There's another thing called revolving loan funds. There are community development loan funds. It's more like one-time funds, and micro enterprise loan funds, which are usually given out to individuals. There are thousands of such community development financial institutions in the United States worth about $25 billion. And typically, the borrowers that deal with CDFIs, when they're successful, they do graduate to the conventional borrowing institutions. Micro enterprise loans are not for profit corporations that make very small and usually very short term loans. Much of this is modeled off of the very successful Grameen Bank in Bangladesh, which enabled many women, especially, to start little businesses with a very high loan repayment rate of 98%, and interest rates that were around 16%. So the fact that these small business entrepreneurs could not only pay back their loan, but with a pretty significant interest rate, meant that not only were there locally available credit options, but that there was an interest for corporations to offer these microloans. And the successful model was based largely on the use of social groups and peer pressure, but many of the loan recipients would have to work closely with their small groups, and in the process, they would receive a great deal of technical assistance, how to run the business, how to handle money, etc. In the United States, there are some successful examples of micro enterprise loan funds, like the Lakota Fund, which began in 1987 with an amount of $600,000. It established businesses with 2 years of business training, so using the same kind of idea of not only giving out the money, the loan, but also providing the tools to help these businesses succeed. But in order to qualify, borrowers need to have collateral and a business plan, just like a conventional lender would probably require. Well, regardless of where communities come up with funds to enable lending and credit, one of the key things that community developers will want to do is assess local credit markets. And that has two components: the supply side, looking at who's offering loans, and the demand side, who's looking for loans, what types of loans. We've already mentioned the Home Mortgage Disclosure Act as providing some data, but this is limited again to metropolitan statistical areas, not to rural communities. The Community Reinvestment Act statement also has a few regulations that come to bear here. There's a delineation on a map of each community served by the institution, a list of specific types of credit that each institution is prepared to offer, a copy of the CRA notice indicating where to get copies of the statement, and information on efforts to assess and help meet the credit needs of the community. So there are available sources of information to assess local credit markets. And in those areas that are underserved, it's usually important to consider the development of community development financial institutions, as traditional lenders tend to find low-income, underserved communities as less desirable because there's less potential profit to be made, at least in the short run. So building these CDFIs is one important strategy. Another thing that we can do is pressure the already existing local credit institutions, especially credit unions that already exist, to take a more local orientation. And if they are being discriminatory, to force them or pressure them to be more equitable in their lending practice. Uh, there's also the use of informal credit markets that are there's a possibility. Um, Identifying external sources of credit, perhaps through the internet or other sources that might create some competition locally for better rates, interest rates. And there are other options like the development of cooperatives, which we'll discuss elsewhere. But this is one of the ways we build financial capital in communities. So, in summary, we could say there does continue to be a concern about the disinvestment or lack of investment in minority communities and poor communities, or where those overlap. So, a variety of community credit institutions have been created to serve the needs of areas that the private lending industry does not serve. So, while there are some very promising models, most evaluations suggest they have only a limited impact. Uh, and the hope is that they will jumpstart successful businesses that can then become more sustainable by turning to more traditional lenders. But you have to reach a certain level of success for that to happen.